Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome to Phil's Tax Hacks and Other Retirement Facts. Phil Putney and myself back to talk investing, finance, and retirement. And Phil, let's get into some common questions this week for folks when they're forced into retirement. We've got kind of like 5 common ones. Where you're at, obviously, you got clients obviously all over the country, but right there in the Metro Detroit area, the big 3, this is a big thing a lot.
Yeah, I mean, there's several of them that are starting to wean down that workforce. You know, they're concerned, I think, with the potential of recession, and so they're trying to prepare.
Yeah, so, they're being
we're having clients that are unfortunately in this scenario that they're nearing that stage, and we're considering it. Now they're getting forced into a decision of, okay, do I take it?
And how do I
give me an offer?
Yeah.
And what do I do? So
exactly. Yeah, and I think that's a great point, by the way, is that the looming 23 year, 2023 on the horizon here. This is our one of our October episodes. And I think when big companies start to do some things like this, that's usually an indicator that they feel it's going to be a tough year economically as well. So certainly something to ponder.
They see some headwinds coming, so they're doing what they can to prepare. So
so let's talk about 5 common questions people ask when being forced into retirement. Number 1, should I accept the retirement buyout that includes a severance, or take the chances and maybe stay?
Generally, the first step in that is they will put offers out, these retirement severance packages to different groups that are within the age range,
just to see who
voluntarily accepts the offer and voluntarily leaves the company.
But before they have to cut the herd, they see who's taking it. Okay.
Yep. The question here is, okay, do I take that, or do I say, no, I'm going to keep, I don't want the offer. I'm going to continue to work.
Yeah.
And take your chances is, okay, well, what the company does the next step is that if they didn't get enough in that first voluntary stage, now they're going to come in and the managers are told, okay, we need to eliminate X positions from your workforce.
Okay.
And now management starts involuntarily picking people. And at that stage, there's no buyout offer. There's no severance. It's sorry,
your
position
off.
is no longer needed.
Yeah.
And you're laid off, So that's the real question is, okay, do I take the severance, or do I, take my chances, and hopefully I'm not one of the selected that if they didn't get enough, they're going to, eliminate my position anyways.
And they typically will start this with, higher paid workers, and also that are close to retirement, right? Because they're kind of looking at that window again. So this is going to be clients or potential clients that you have. So when you're thinking about that, then it becomes the conversation of, okay, so is it the lump sum, right? Or is it basically, for lack of a better term, the monthly, it's like an annuity basically, right? It's what it is, right? The monthly payout.
Right. Yeah. So part of that option is, first is looking at severance, that piece of it, just the basically a lump sum payment for your remaining period of time. Maybe it's a 12-month, a 6-month. Every company is a little different in how much they give you in a quote unquote severance to leave early.
Maybe
the second is
days, maybe it's whatever, right? Yeah. All that
stuff. The second is, okay, if your company has a pension, part of that retirement, because now you're retired, you're taking that option, you're retiring. If the company has a pension, you generally have kind of a high level, 2 options. You're either taking the income, that annuity stream, so to speak.
Right.
And there's several options there, whether it's single life or some kind of a survivor benefit, or do I take the lump sum? And that's the next big question if your company does have a pension. And we're dealing with a lot of that in our area right now. And that's a real key question, especially in the time frame we're in, because lump sums are an interesting number. Statistically, how they work is the actuaries for that company pension is basically figuring the math to say, okay, well, if we've guaranteed this employee X amount a month for the rest of their life, based on current rates, and in that pension plan documents, they've got certain rates that they have to use, federally established rates. They determine if I have to give somebody $3,000 a month for the rest of their life, then if the federal rate that we have to use is 2%, well, I have to give them a bigger chunk of money at earning 2% to get that pension, that guaranteed income, because the pension didn't change.
Right, right.
But the interesting factor that's going on right now is that all these pension plans have a annual kind of a renewal where they redo that calculation, and interest rates have risen dramatically.
Yeah, for sure.
So unfortunately, if you're looking at this decision, do I take the income? Do I take the lump sum? That lump sum, if you wait, we've seen clients that are having a decrease in the lump sum of 20 to 25, maybe even 30%.
Oh, wow. That's hefty. Yeah.
Because interest rates have risen. So again, back to the math, if I still have to give you the $3,000 a month, now if interest rates went from 2 to 4, well, I don't have to give you as much in a lump sum because the rate we're using to project is a higher rate. So it's a less of a lump sum to get the income.
Yeah, and I don't think most people even would think about that in those terms, right? We are presented with lump sum or the monthly payment, and we look at the number and most of the time in this industry, you hear the lump sum, and many advisors say, hey, the lump sum's the no-brainer because you have more control. You can do more things with it, right? You take the money, you put it in an IRA, you got more smorgasbord, blah, 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 right? You can invest it your own way. But that's a really interesting vantage point sometimes, because that's not something that the average person that we would just think about. No. And if you're thinking about the big three, for example, since it's just the area that you're in, some people say, well, don't take the monthly payment because what about the stability of the company, right? Well, the big three probably aren't going anywhere, so you feel a little more comfortable, obviously, with something like that than you would maybe a smaller company. So it's a lot of variables in there that at first glance you might not think about.
Yeah, and getting into that, lump sum versus the pension income, I mean, there's a lot of variables to consider. That's one of them is the viability of the pension. As long as the pension's fully funded, then the company doesn't really matter because the pension assets are what's covering the pension income.
Right.
Where the company matters is if the pension isn't fully funded, and oftentimes that is the case, especially as markets and everything go up and down. So if the pension isn't fully funded, now whatever that difference is falls back to the company as a liability.
Right.
And if the company goes under, now the pension doesn't have enough assets. That's where then the Pension Benefit Guarantee Corporation, the PBGC, has to come in and kind of help shore up the pension. And if that happens, unfortunately, there's some maximum payments that are going to happen. Most people end up losing, up to half of their pension, a pretty substantial amount.
It's pretty substantial.
So it's not an option you want to choose. So, that's one of the factors, but then it's just beyond that, running the math to see, do I take that lump sum, more control? I can help keep up with inflation. That's one of the biggest disadvantages to a pension is most of them are level.
Right. There's usually don't have COLAs, right?
If you're getting $3,000 a month, then it's $3,000 this year and so if we're at 8% inflation, you're not buying as much next year because the same 3% is there. So, or even
8%,
even 5 or 3, 4, whatever you want to use, it doesn't matter. You're losing value every year and it goes down pretty quick. So there's a lot of consideration.
I love the 8% or 9%, whatever number they want to put out, because we all know it's kind of bupkis, right?
Yeah.
Especially with energy and food is not in that.
Let's take those out. Yeah. We don't want to count
because they don't affect anything.
No,
not at all. So,
it's not like one of the biggest line items in your budget.
I know, right? I love how they have their little
in housing,
creative ways to kind of get around that. So we definitely feel like it's a lot more than just the official numbers. But anyway, back to the topic here. So, what about just like the severance portion? If someone has that option of just the severance part, one-time payment over a couple of months. My brother's kind of in that boat. I think I've mentioned before that he's looking at that they're probably going to retire him next year when the contract ends. He's a contract employee and it'll end next year, which is close. It's a little short of when he was planning to retire. And now they've told him, well, we might try to keep you a couple more months. And he's like, hey, if they keep me a couple more months and they let me go, I get the severance versus, if I just hit that point and I'm like, yeah, all right, I'm
done. Yeah.
Keep extending it. And I'm like, okay, now I'm done. I leave. I don't get the severance. So he's kind of weighing those options too. But then the question becomes is how do you take it over a few months, which he would like to do, or, one big chunk?
There's a lot of factors that go into this. The biggest one to me really is the tax side of it, because think of it right now. So let's say that's your scenario. You've been presented this offer. We're, coming up on November.
Right.
You know,
And
so
same with the year.
and the offer is, you know, by December 1st, you have to take this offer.
Right.
So you've got 11 months of pay already this year. And if they're going to give you a lump sum, that's taxable this year in addition to 11 months of compensation.
Yeah. Does it kick
you got to
up?
look at you got to look at the tax brackets, and does that all of a sudden put me up into a higher bracket where it doesn't make sense? Maybe I push that into next year to keep my brackets lower.
That's a good point.
Kind of the flip side of that to consider too is that whole Social Security and Medicare. Medicare not so much now because there's no cap, but Social Security.
Right.
You know, so if you're already above the Social Security threshold, you know, then if you get this severance as a lump sum this year, you're above it, so you're not paying that extra 6.2%.
Okay.
Versus if you throw it the next year, starts all over again. You get another year. You know, so there's, to me, the biggest piece here is the tax. Understand, you know, the tax side of it. Do I take it this year? Do I wait?
Yeah.
Pros and cons.
Yeah.
You know, and then the other piece of it is just the pure management of it is, I mean, everyone wants the lump sum. That's great. But if you're getting 12 months of a lump sum, that has to last you 12 months.
Yeah.
You know,
are you going to do that? Right.
It's not yoo-hoo, you know, I've got, you know, $100,000 now sitting
true.
in the bank, and, you know, I've always wanted that new whatever. And
that's
all
true.
Of a sudden it's tempting. It's
that's
supposed to last you 12 months. So.
Yeah. That's where he's at. He sits there and looks at he keeps not getting himself a classic car, but he really wants one. And he keeps looking at mine and he's like, and I'm like, oh, don't do it. Don't do it.
Which I'm not saying it's not an option. As long as with all of this, it comes down to having a plan. You've got to run the numbers and see how it works.
Call from the classic car. So
okay.
So I give him a little bit of a tease on that. But anyway, so again, when you're thinking about these common questions, and I guess I should get back to it, but the first one again was, you know, do you accept the buyout offer or do you take your chances? The second one was, do you accept the pension or do you go lump sum? The pension or lump sum.
Pension or lump sum,
and then the third one was, you know, the severance question that we just tackled. The fourth one is, what about, are you seeing folks coming in who say, hey, what if I take the offer, right? So kind of the elected offer, and maybe I get another job, right? So maybe I look for something else, or how close am I, right? Do I need to do that?
You know, do you have to get that job? Is that part
do you want to? Do you have to?
Or do I have to is one, you know, section. Do I want to? You know, even if you don't have to, are you just not ready yet to retire? You still kind of enjoy your field or whatever it is. Maybe you're just stressed out at your current position. In fact, I'm working with a client right now that's going through this exact decision. You know, I mean, he's a little early, probably 5 years earlier than what he's anticipating, you know, so really wasn't ready to call it quits today, but he is done. He's just under too much stress at work and ready to look for something different.
Yeah.
So he's doing this. He's taking the option. We're going to, you know, go ahead and take the offer. In his case, the lump sum made sense. And again, not to say that's right for everyone. You've got to run the math and see what it looks like. But he's not ready to quit yet. So he's actively pursuing other positions to see what's out there.
So when he came to you and said, you know, hey, this is what's being on the table. I'm burnt out. Let's make this work. You have to then go in and retweak that plan.
Right. We're just running the math to see, okay, this is what it looks like.
What's going to happen by doing this now versus what the prior plan was when you were working there for another 5 years or whatever.
Right. Yep.
Okay. Yeah.
Yeah. So really, it's one of these decisions you don't want to just jump into and say, hey, I did this thing, you know.
Especially if they call you up and say, yeah, you're on the voluntary list. Would you like to retire early? And they present you with that. Big takeaway, and we'll get to that in just a second, is definitely if you don't have a financial professional to talk to, go talk to one. Yes. 'Cause there's a lot of little caveats there. The final question, and we'll finish it up with that, Phil, is people definitely wonder, will I have trouble getting rehired at an older age? He does the same thing. He's in IT. Yep. He's like, well, you know, and he's the one. And the reason they're extending, and I keep telling him, the reason they keep extending his contract is because he's one of the best performers, right?
Yep.
And he knows this. He's like, and that's great because they've seen my quality of my work. But if you're let go and you have to look for something else, they don't know you from Adam.
Right.
And so, yes, we know there's not supposed to be age discrimination, but let's be honest,
just a matter of
harder to get a job, right?
And unfortunately. Typically it is. I mean, I've got another client that I worked with or am working with that had gone through this very scenario, unfortunately, like 3 years ago. Okay. And his plan was it wasn't an offer. He just got let go. They eliminated his position.
Oh, okay. Yeah.
So we went through all the same thing, and his plan was to go back to work, and he had actively pursued this for a good 2.5 years. And it took him a long time to find a position.
Yeah.
Unfortunately, it's just the day and age we live in, right? I mean, companies, we recognize experience and that value and a lot of other things. You want experience when you're talking to an advisor or a doctor or whatever, but in the workforce, I think experience is one of those things that has somewhat got thrown to the wayside of they're looking for dollars.
Yeah, I will say the sunshine aspect there is, and again, I try to find the occasional silver linings to the whole COVID thing we've had to deal with, is I think that it's also shined a light on the value of the folks with the work ethic. I won't put anybody into a category. I'll just simply say that it's one of those things where I think people go, oh, this person has a great work ethic. Yeah, they might cost us a little bit more because of their seniority, but that's probably going to be worth it. So I do think that has changed a little bit since maybe the 3 years ago, like you first talked about with the other gentleman. So maybe, right? I mean, it's not all gloom and doom, right?
No, not all. But I mean, and this is always the battle in large companies is that battle between accounting, and then the management, the people running the actual, department and trying to make things work. Accounting doesn't see all that stuff. They just say, hey, this person costs us 20% more. That's the bottom line number they're looking at.
Yeah, true.
The manager's looking at it and saying, I'm paying 20% more, but I'm getting 30-40% more in productivity.
Right.
And they're doing their job versus if so anyways.
And that's where hopefully a good supervisor comes in and is fighting for you, right?
Yeah, exactly. So
at the end of the day, go ahead.
Okay. I was going to say, just to throw one other consideration out that's not in here, but healthcare. I mean, that's one of the big factors too.
Yeah.
So especially if you're running through this scenario and you're not 65.
Yeah.
Because now you're kicked out of, the workforce, so to speak, from a health insurance standpoint. You're put into the marketplace, which is generally very expensive. And in today's market, as a general rule, I mean, if you look at it, COBRA is oftentimes the better option. Which
is that offered usually in these buyouts, Phil? Is that?
They have to. Yeah, companies have to offer. It's 18 months of COBRA.
Like 18 months of COBRA. Okay.
But I mean, it used to be. I mean, for years, COBRA's never been one of those. Oh, you don't ever take COBRA, you can get it cheaper.
Oh, yeah.
COBRA today is generally the less expensive and better coverage.
That's crazy.
Than what you can get on your own in the marketplace.
That's crazy.
So, and it's just it's outrageous. So it's a very large expense you have to consider.
Yeah, that's a great point.
So even when you're running through all this math, you've got to look at that factor to say, okay, well, that's great, but now I'm paying COBRA or whatever, and this is what it's going to cost me.
Well, that worked out well because I was going to ask you any wild cards that
that is the wild card right there.
So there you go. So I'm glad you brought that up. It's a great point. So so common questions about that whole, if you're being forced into it or it's at least being presented or being talked about, and we're seeing more and more of it. We probably will see more of it into next year as well.
Yep.
Who knows, but things can change, but certainly is something that you're experiencing right now, which is why we decided to talk about it this week on the podcast. So folks, if you do have this in front of you, if it is a question that's being brought up and you are not working with someone, please take the time to call 1, 2, 3, whatever the case is, call some financial professionals, have a conversation and find out, to Phil's point, the taxes, some of that nuance to how the rates have changed, how the payout and the monthly might work, all that good stuff. Great tips in there. Make sure you're having those conversations. And you could, of course, reach out to Phil if you'd like to at 248-888-7530. That's 248-888-7530. Of course, stop by the website, philstaxhacks.com. That's philstaxhacks.com. And don't forget to subscribe to us on Apple and Google and all that good stuff. And if you got questions, again, reach out to Phil. He'll be happy to help. Phil, my friend, thanks for hanging out and chatting. Good stuff today.
Yeah, absolutely. Have a great day.
I always appreciate your time. We'll see you next time right here on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.